Hello everyone, I'm Marg Franklin, President and Chief Executive of CFA Institute. I'm honored to welcome you and our esteemed panel to this lively discussion. For those of us in the investment industry, we've long been familiar with Jeremy Siegel's Stocks for the Long Run thesis. Siegel made the case in the 90s that stocks are the best long-term investment. Of course, off years and volatility are always inevitable, but according to the theory, stocks will outperform bonds when examined over long time horizons. This thesis serves as a foundation to modern finance, portfolio theory, how we construct portfolios and allocate assets. Indeed, the foundation of what we do. In a recent issue of our Financial Analyst Journal, Professor Edward McQuarrie introduced new data that was not available in the early 90s, and he endeavored to re-examine the long-held theory. His resulting article sparked widespread discussion throughout the investment industry, a debate that has been incredibly thought-provoking and stimulating to observe. So we were keen to explore this new research alongside Siegel's theory in more detail. Today, the CFA Institute Research and Policy Center is thrilled to bring together financial luminaries Robert Arnott, Elroy Dimson, and Roger Ibbotson, alongside Jeremy Siegel and Edward McQuarrie, to debate and discuss the theory and how this new data uncovered in the FAJ article impacts conventional approaches. The discussion will be moderated by Larry Siegel of the CFA Institute Research Foundation. I know you will find the conversation engaging and practical. I'm personally thrilled to take it in. Discussions such as these make us better practitioners. I hope you'll leave this event feeling inspired, enabled, and educated. I encourage you to keep an eye out for additional content to follow on our Enterprising Investor blog and on our flagship podcast. Of course, I also encourage you to read the original works by Sigel, McQuarrie, and the additional luminaries who have contributed their thoughts to our various channels over the years. I'd like to extend my deep thanks to everyone who made possible this event, as well as our participants in today's discussion. Your contributions to our industry are invaluable.
It's a great honor to be here. It was 5 long years in the archives, making the honor that much sweeter. I want to thank the CFA Institute for organizing this panel. I want to thank the editors of the journal, William Guestman and Louis Garcia-Fejou, for indispensable guidance as that paper moved through the review process. Just note to my fellow panel members, I'm going to be speaking to the viewers more than you on this talk. Here we go. In a bit, I'll review what I did and what I think it means. But first, viewers need to understand the 2 huge advantages that I enjoyed. First, I came very late to the party. That meant I could stand on the shoulders of people like Roger and Elroy. Most important, I had the benefit of work done by Richard Silla at New York University. He sent a team of researchers out to scour the archives for newspapers published before the Civil War. He had a hunch that widespread stock and bond trading in the U.S. went way, way back, and if it did, he would find price quotes in those old newspapers. He was right. He compiled over 100 stock series, dozens of bond series, entered these in a spreadsheet, and there it was waiting for me. Okay? Right from the beginning, I had all the names of the securities of consequence and all the price series for those stocks and bonds. But no dividends and no share counts. Now, my second huge advantage came from being retired. Let me explain. When Jeremy formulated his stocks for the long run thesis in the early 90s, he was definitely not retired. He saw an opportunity to contribute to theoretical work on the equity premium by lengthening the data series. So he consults Sidney Homer's History of Interest Rates. There in Table 38, Homer provides a 100-year series of bond yields. Apply the formula for price appreciation, and bam, Jeremy has bond returns back to 1802 and can proceed to the theoretical work. Now, I'm retired, and I'm reading Homer too, mostly out of curiosity. My question becomes, where did Homer get those yields? Oh, from Frederick McCulloch. Nice chart here showing the bonds used in the index. I see there Haverhill, Massachusetts. We played them and track. Tiny bird back in 1970. Smaller yet 100 years before. Why is tiny Haverhill setting the benchmark interest rate for the late 19th century? And why does McCulloch have so few bonds in his index at any given time? So again, I'm retired, leading me to ask, where did McCulloch get these bond prices? Oh, from Joseph G. Martin, the Boston stockbroker, active through about 1900. Looking at Martin, and I see that McCulloch has only used a fraction of the bonds there. It occurs to me to compare the yields on the bonds McCulloch left out to the yields on those he included. Whoa. The ones left out had higher yields. Now came the big discovery. Figured for consistency, I better calculate yields my way on the bonds that McCulloch did include. They're higher. You know what? McCulloch was not reporting an average yield on our portfolio, as Homer thought. McCulloch was eyeballing the yield range and finding what he thought would be the absolute minimum conceivable yield, at that particular time. And that's why Jeremy's bond returns are so low after the Civil War. They were based on an artificially depressed hypothetical construction. And one more story about being retired. That allowed me to sit there at home typing dividend, New York Bank, 1930, dividend, Bank of Pennsylvania, 1915. And so one day I find a book by Thomas Goddard, active in New York City from 1819, possibly the first person in the world to self-identify as an accountant. To promote his practice, he would publish a list of all the large banks, first in New York City, then Philadelphia and elsewhere, with the share counts and with the dividends. Jackpot. I already had many dividends from Henry Varnum Poor's History of the Railroads and Canals of the United States of America. Now I had share counts and dividends from Goddard. I had the Boston share counts and dividends from Martin. And I was on the downhill slope to getting all the dividends. I'll spare you the fascinating details on how I got the last 20%. Let me summarize what I did. I built from scratch a capitalization-weighted total return with dividends stock series from 1792 to 1870. I improved the existing stock series from 1871 to 1897, linked those to the same post-1897 series that Jeremy uses down to the present. I also built a bond return series from 1792 through 1925. This is the first time we've had a bond return series based on observed prices for a broad portfolio of federal, municipal, and corporate bonds as these became available. I linked that new series to Rogers' long bond series down to the present, again, the same one that Jeremy uses. What does the new record show? Sometimes stocks beat bonds. Sometimes bonds beat stocks. Sometimes they perform about the same. And those three statements hold regardless of holding period. Now, to finish up, let me anticipate an objection. The Panic of 1837 was a bad time in the stock market. For some markets like Philadelphia, it was almost as bad as the crash of 1929. The largest single stock of that era, the Second Bank of the USA, accounted for about as much of total U.S. market capitalization as the Magnificent Seven do today. Call it 30%. It failed spectacularly, plunging from $1.20 per share to $1.50 and never recovered. Imagine the Magnificent Seven collapsing 99% next month. Jeremy's sources had omitted the Second Bank of the United States. It did not trade in New York, so it is also omitted from Rogers' 19th century history. The true dimensions of how poorly stocks had performed prior to the Civil War were not visible before the new record was assembled. To which you might object as follows: Professor, why should I care about market history from 200 years ago? Everything was so different. No way these stories are relevant to investing today. I saw that one coming. The paper includes a brief supporting account using the international record compiled by Elroy, Brian Taylor, and others. It shows also many occasions where bonds beat stocks, now as before, over periods decades in length. The international record likewise shows how you can lose money in stocks over 20 and 30-year holding periods. It's not just Japan after 1989. And by the way, I excluded periods where a nation lost a war or got invaded or occupied. Those results are for intact nations in peacetime. And that is why you should pay attention to 200-year-old U.S. data. It replicates the international data, which U.S. investors might otherwise dismiss on grounds of American exceptionalism. And the international data replicates the 19th century U.S. data, which you might otherwise dismiss as too old. Together, they establish that sometimes stocks beat bonds, other times not. Larry.
Well, thank you for that fascinating exploration of history. I've done a little of that myself, and it was nowhere nearly as diligent, but I'm not retired. And if I ever retire, I may choose a different path to occupy my time. So thank you for doing that. Let's move immediately to Jeremy, and who will respond. Thank you.
There you go. Stocks for Long Run. It did come out with the 6th edition. And this is what all you, and I'm proud to be included as saying the iconic chart from there: stocks, bonds, treasury bills, gold, and the dollar. That's a dollar relative to inflation. And up on the upper left, you can see the compound annual real returns. I do take the period, the early period up to the coals, and then take the period, basically to 1940, when the depreciation of the dollar became very significant in there, divided into those 3 periods. Here we see that the equity risk premium is about 3.5% here. On bonds, over 4% on treasury bills going forward. You also have the period that bonds did extremely well from 1981 until just the year after the pandemic. And you can see that slope is the same as stocks. And of course, it has a lower base, but is the same in stocks. I remember when Rob, you wrote an article, Rob, or you texted people and saying, hey, stocks don't always beat bonds. 40 years of from 81 to 2021, I think that they were virtually the same. And I agree on that.
Of course, that's here owns.
Yeah. If you don't like the earlier data, I also have the real returns benchmark to the Coles Foundation. 68271309 minus 2. If you don't like that, we can go to the Ibbotson period. I mean, in just, who first benchmarked for all of us the long run real returns. And if you want to take a look over here at 1802 to 2023, then 1871 from the Coles Foundation. I do understand that Ed made a few changes in the Coles Foundation, but I think he said they were virtually the same as that. So 6.8, I get 6.8. He gets, of course, much less in the earlier period. This is running all the way through 1802, 223, 1871, and then 1925. And then bonds keep on going down. I'm going to talk about that. The bills go down, except the last period. The dollar inflation goes up during that period. I think I have the same thing over here. Yeah, this is your iconic chart. Am I right, Ed?
I can only hope, Jeremy, that someday.
Is that it gets so iconic. So in the earlier period, as he says it's back and forth. Bonds do much better in the earlier period. Stocks do worse. Then there's that period where decisive. Now that is where interest rates went from 3% to 16%, and then 16% to 0.5%. By the way, Ed, if I'm right, I mean, you do not have the last 2 or 3 years in your data series where bonds have done very badly, as we know.
That is correct. The published chart there stops at December 2019.
Yeah, I mean, even in the long-term chart, if I can go back there, you can see the turndown in bonds, which is really quite substantial. By the way, my 200-year series went down from like 3.5 to 3.3 just as a result of what's happened to bonds over the last 2-3 years. And you could check that. You could check that out. So, I mean, if you're just to me, I still see superiority in stocks, chopping off the earlier period and chopping off even the middle period, as we had said. I also think this is a very interesting graph that is in Ed's work. The correlation between bonds and stocks. And you can see it's gone down. Now, from being very high and down. And that is because we are basically going from bonds that have a lot of equity risk in them. You could call them junk bonds or whatever, down to what we now call the risk-free asset. What I was trying to do in my book was, yes, I was not trying to get a diversified portfolio of all the bonds. I was trying to get the lowest bond that represented the safest risk-free asset, because that is how finance treats the equity risk premium. And I think that when you see this, how low the correlation goes, it's because you're going from bonds that are very much more stock-like and much more riskier, and clearly should have returns that are close to bonds, to the risk-free rate. And by the way, here's a 3-year rolling correlation over the last 90 years of stock and bond returns. You can see how it's turned up recently. Let me say that I think that one of the most ignored of all factors in what is the determination on the bond is its correlation with risk assets. I mean, we talk about the Fed, we talk about real growth, and other liquidity problems, but is it a good hedge or not? And of course, it is not surprising that the period of lowest interest rates in the U.S., in fact, lowest in the world history, when I believe the 10-year got down to 57 basis points, occurred when we had extraordinarily negative correlations between stock and bonds, and they were negative beta assets and viewed as extremely good hedges against stocks. And if bonds are not viewed as good hedges against stocks as they weren't in the 70s or in the 80s, they will get higher yields just because they don't diversify your portfolio as well. So a lot of the bond return, what determines long-term bond returns is its perception on hedge. If you don't, inflation risk is the worst risk for bonds. Geopolitical risk is a negative beta, makes bonds negative beta. The pandemic, they went up during that, negative beta. Financial collapse, in 2008, 7, 8, that does negative beta. But if inflation is one of the problems, you do not have a good hedge, and you're going to have higher yields. And it's not just a Fisher equation effect, it's also a correlation effect. I'm going to hold this because later on we might talk about dividend yields in the long run. So I'm going to just hold this in abeyance and go just to some points that I think are important. I didn't want to steal Elroy. The equity premium is pretty persistent around the world at about 3.5%, even though some countries have much lower rates on bonds, stocks, but then they have lower rates on bonds generally. And by the way, as Elroy shows in his international, the U.S. does not have the highest dollar returns from 1900 to the present. That's 123 years. So, there is an exceptionalism of some sort, but not complete. We have to admit no one has satisfactorily explained the magnitude of the equity premium probably ever since the famous Mara-Prescott work. It should be much lower, but there should be one, but it is what it is, and it seems to be pretty persistent as I can tell. As I said, the episode in 81 to 2021 is extremely unique. Bond yields went from 16 to 0.5%. Are we ever going to see that again? Well, who knows what we'll see again? But that is why you had the bond yield during those 40 years was something like 7 standard deviations above its mean, while stocks were actually above their mean, but I think only about a half, and so the two equal. Just let me tell you, looking forward, I see the 10-year TIPS is now 2. Stocks are 20 times earnings, which to me is a 5% real yield. Presto, that's a 3% equity risk premium, and that is very near the historical average. So maybe a little bit shaded from the historical average, but not very much. Just looking today at stocks and TIPS as the comparison. So that's the end of my presentation. I'll quickly get back to my iconic graph. So listen, Ed, you go into the weeds, and you did a great service for our profession. Absolutely. The question is, and I know you try to answer about whether the early period really matters or not. I mean, that period from 81 to 2021 is extraordinarily unique. And of course, bonds way underperformed getting into there. Bills might be the better, smoother way of looking at how you do in fixed income relative to that. And also, again, I was trying to get the risk-free rate. I was getting the lowest bonds around, not a portfolio of all bonds, which certainly if you have a riskier portfolio, you will do relatively better in. But yeah, you should lower the earlier.
Yeah, I would like to comment. First of all, I'm going to talk in some detail about the post 1981 period that Jeremy addressed and that Ed brought up as being a decline in the equity risk premium. I don't believe it is, as Jeremy said. Jeremy said it well, but I'm going to cover it in far more detail. Also, though, as far as these correlations between stocks and bonds, that's a pretty complicated situation of what the correlation should be. Both stocks and bonds have an inflation component that would make them positively correlated, but basically in any kind of crisis, there's a movement of stocks to bonds which make them negatively correlated. Also, when there's a big change in yields, it doesn't necessarily affect the stock market the same way as it affects the bond market. So you have again a big impact. So if inflation pops up quickly, really hurts the bond market. But stocks being in real terms haven't pick up what's really going on in the economy and not work the same way. So I got to say, though, basically what I'm saying is in concurrence with what Jeremy said. It's just elaborating on it a bit. As far as I will say, though, to Ed, I mean, I'll say that because he's just off there. He has done a great service, and he did. Will Getzman and Ling Peng and I put together the data back to 1815, and but we did restrict it to the New York Stock Exchange, so we didn't pick up one of the other markets that had picked up, and we did not get all the dividends data. So again, we found other sources, and that's much appreciated.
I have a question for it. Go ahead.
I just wanted to echo. You can see that the depreciation of the dollar against inflation almost all occurred since 1940, and has had no real effect on the stock returns, as one would expect, because they're claims on real assets. Bonds get hurt. I mean, yes, investors try to get that premium eventually in it, but the net is, unless you have tips, is still the paper money return will get hit in inflation under those circumstances. So that's a hedge that stock provides that that bonds do not, in my opinion.
Next speaker is Rob Arnott.
What I'd like to do is to talk about a few things. Firstly, semantics. The words risk premium are used to describe differences in return between stocks and bonds or stocks and cash. Really, the risk premium should be an expected excess return. The actual excess return will be the starting risk premium plus or minus whatever was unexpected by the market. And excess returns should be used for realized excess returns. One of the reasons that this is important is that a lot of the discussion of risk premium relates to past excess returns, which include exogenous shocks, which include one-off changes in valuations. Second observation is, and I'm working on a short piece that maybe I'll submit to FAJ as a perspectives piece, that it should never have been called a risk premium. It's a fear premium. It's a premium related to people being afraid of downside risk. In theory, a risk premium should never be negative. The expectational risk premium should never be negative. That's not to say excess returns can never be negative. That would be foolish. But with fear of missing out, let's take today's Magnificent Seven as an example. The fear premium can be negative. People can view cash as a riskier holding relative to long-term expectations than holding the Magnificent Seven. A fear premium also, just as an aside, would have led finance theory to expect a size effect. Smaller stocks are a little scarier. There's less known about them. A value effect, a momentum effect from fear of missing out. Indeed, most anomalies would have been anticipated and would never have been viewed as an affront to efficient markets, because a fear premium is inherently at odds with an efficient market. Third observation is that third observation is we should never mistake revaluation alpha for a source of sustainable future returns. Revaluation alpha is a big part of recent returns, a huge part of short-term returns, by which I mean anything 10 years or shorter, and a startlingly large part of even relatively long-term returns. Finally, I think we should observe that long horizon mean reversion is a very reliable force at work in all aspects of the capital markets, in profit margins, in growth rates, in valuation multiples, and in returns. Looking at Ed's newly iconic stock bond graph, we can see that there are long periods of back and forth returns, decisive stock market superiority during upwards of half a century, and fluctuating advantage subsequently. it's hard to look at this and draw any reliable conclusions as to the notion that a substantial risk premium, 3 to 5%, which is larger than finance theory would suggest, is sensible, that a large risk premium is a reasonable expectation for the long-term investor, unless you have anomalous circumstances where stock market yield is abnormally high and bond real yields are abnormally low. This is another version of that same graph. I wrote a piece in the FAJ entitled Dividends and the Three Dwarfs back in 2003. And one thing that really struck me was that for the entire 19th century, 100% of the stock market return was from dividends. Everything else canceled. Now, that was also 100% of the real return because there was no inflation. We were on a gold standard. There's another really remarkable period, and Jeremy drew attention to the astonishing results for bonds as yields plunged from 1982 to 2021. But there's an equally astonishing period for stocks, a half century. I mentioned that revaluation alpha should never be disregarded because it can be massively important. Stocks beat bonds by 8% per annum for a half century, but only 4% of that remains after you take out the 7-fold rise in price to dividend ratios, a revaluation alpha. The dividend yield went from 8% at the end of 1949 to 1.1% at the end of 1999. If you take out the drop in bond yields, now it drops to 3%. So over this half-century stupendous period for equities, only 3 out of the 8% still exists after you take out revaluation alpha. Now, 3 is still a great excess return, and as Jeremy points out, that's in line with the very long-term historic norms. So we can also look at the question of growth itself. Do earnings and dividends grow with GDP? There's a common view, widely held in academia, that earnings should grow with headline GDP, and indeed they should. Earnings and dividends, if GDP grows tenfold, in a capitalist economy, earnings and dividends will grow tenfold, but not per share. Macroeconomic growth consists of growth in existing enterprises and creation of new enterprises, and you can't invest the same dollar in both. The result is that growth of earnings and dividends on existing stocks grows slower than GDP. Bill Bernstein and I wrote a paper called The 2% Dilution back in 2003, which explored this, and we found that real growth in earnings and dividends generally around the world, courtesy of Elroy's data, tend to grow about 2% slower than GDP. And this makes sense because growth of productivity will fuel real growth in return on labor and return on capital, which in a healthy economy ought to be roughly pari passu. I would also draw attention to the fact that, just a moment, let me change this a bit. The fact that real earnings growth averaged about 2% a year until the last quarter century. The last quarter century, it doubled, more than doubled that. So we have extraordinary growth in real earnings, and that real earnings base tends to mean revert. This is a graph that comes out of work that I did with Cliff Asness back in 2003. And what we found was that when earnings are way above, when real earnings are way above their 10-year average, subsequent earnings tend to mean revert. So the year-end 2023 level, real earnings were 67% above the 10-year average. That's huge. That's in line with the all-time extremes, and earnings do tend to mean revert. So this would lead to a reasonable expectation that earnings growth in the coming decade would likely be a good deal slower than what we've been used to. We also find that the Shiller PE, cyclically adjusted PE ratio, is a wonderful predictor of long-term real returns. I like to do the Shiller PE on the log scale, because going from 5 to 10 or 10 to 20 or 20 to 40 has roughly the same impact
in terms of expectational returns. And sure enough, if you do it on a log scale, you find that the next 10-year real return is very much a factor with roughly 60% correlation between the starting Shiller PE ratio and the subsequent 10-year return. Another way to look at that same relationship is to plot the Shiller PE ratio, the blue, and against it to plot the 10-year subsequent stock market returns. And you can see these are beautifully correlated, highly predictive. So people dismiss the Shiller PE ratio only when it's at extremes. I also would draw attention to the regression line, which suggests that when we were an emerging economy back in the late 19th century, the normal Shiller PE ratio was about 13. Now, just based on a simple line of best fit, it should be around 21. And so mean reversion in valuations would tend to point to lower forward-looking returns as well. We can go long periods of time without a new high in stock prices, meaning that for these long periods of time, all you get in terms of real return is the yield. That's all you get. And there are also long-ish periods of time, there are also periods of time when valuations do move stupendously, creating a surge of returns and then a new plateau. Relative to bonds, assuming the short data is right, and I did not plug in Ed's data for this, assuming the short data is right, you get long periods of time where bonds actually beat stocks. That I cherry-picked here. I looked for the period of time from 1802 to the last date where you hadn't beat bonds. And of course you beat bonds in the late 19th century and early 20th century on up to the peak in 1929. But in point of fact, you could go all the way forward to 1946 and you have not beat bonds if the short data is right. So that concludes my formal remarks. There's some additional information if questions come up.
I have some comments.
Thank you.
Okay. Okay. First of all, Rob and I have gone back and forth on the earnings growth issue for how many years, Rob?
About a quarter century.
Yeah, a quarter century. Okay. The earnings growth is the faster earnings growth of the last quarter century or half century, or however you want to put it, is due to the substitution of buybacks for dividends and the substitution of capital investment for dividends. The dividend yield has gone way down. As pointed out, it was nearly 100%. Now firms use dividends to finance growth, and therefore earnings growth should be faster. So I do not regard the faster earnings growth as something that has to mean revert. And in fact, if I can share again, that was that screen because I was anticipating Rob might talk about this issue. Let's see if I could I'll get it. Yeah, if you go down, here is reported earnings growth, real dividend yields, real capital gains, real stocks, and the payout ratio. And we could break it in many different points, but you can see that, for instance, from 1871, let's just use the Coles time here because that's really where we have, the best earnings, at least earnings. It was 66% from 1871, 1945, which was even earlier, went down to 48.3%. And you can see that the real dividend growth and the real earnings per share growth also rose during that area as it should during that period. So it's not a matter of mean reversion. It's a matter of firms financing their growth in different ways and using their earnings for buying back shares, which of course increases growth rate of shares, price of shares, and of course reduces the dividend yield. In a pure theoretical model, a firm that, let's say a firm with 10% dividend paying out all its thing, the 10 PE ratio, 10% dividend, 10% return. If it instead takes the 10%, buys back its share, it'll have zero dividend and it'll have earnings growth of 10% per year, even though organically it is not growing at all. And will give exactly the same return. I'm sure we've all, talked about this in finance courses when we teach finance, that isn't. Now we could talk about why, that might not be the case in the real world, but I certainly theoretically, if you shift from dividend yield to buybacks or financing your own growth, you will increase the dividend. And in fact, I believe Schiller himself, about, 10 years ago, shifted to a total return CAPE ratio because he recognized himself that the faster earnings growth was distorting his 10-year average that he had on the CAPE, and that lowered the overvaluation. Didn't eliminate the overvaluation, but lowered the overvaluation of that. Second point I would like to make: should PE ratios be the same now as they were in 1871 or before? I say no.
Of course not.
I say they should be higher. I say they should be higher because transactions costs are lower. The ability to get a perfectly diversified risk-return portfolio is almost costless today, while it was very costly to do so earlier. Higher liquidity, higher price. The 5% real return I see now forward is probably what the 6.5% real return on the index was for almost everyone else before. And by the way, one could also say the same of bonds. Bonds have gotten much more liquid. I mean, we're actually going from riskier bonds to unriskier bonds. That actually builds in a capital gain on these bonds, just like a higher PE ratio would build in a capital gain for the stocks. Now, I'm just saying that is justified, and that's why I have a lower real return. I don't have 6.8%, I have 5%. But I don't believe it's due to mean reversion. I believe it's just to the fact that you have a higher valuation. That's it.
Let me just give a 30-second response here. I've been arguing with Rob Arnott on this too, because of the buybacks. We've had many back and forth, letters from the editors, financial analysts, journal, and so forth, especially with the work that I've done with Philip Strahl. And basically what's happened now with the payout ratios are essentially the same as they have been historically. It's just been a big switch from dividend yields to buyback. So I'll leave it at that.
By the way, I would not disagree with anything either of you said. I would disagree with the magnitude of impact that can have. If you've got a Schiller earnings yield today of 3, Jeremy, you talk about an earnings yield of 5. That's based on earnings that are 67% above the 10-year average, real earnings. And so that's a dangerous number to use. If you use the Schiller earnings yield of 3, even if 100% of that flows through to real growth, you add in the yield itself. That gives you a 3% real return expected, even if you capture 100% of that, which historically you don't. So I think we would disagree at the margin. I think we would agree that the points you raise are correct. I would quibble with whether that makes more than about a 1% difference in long-term expected returns. We've gobbled up.
You're basically saying earnings are way above trend, even you say earnings are way above trend, even correcting for buybacks. Is that correct, Rob?
Well, buybacks are, whether you pay out dividends or pay out money for buybacks, the earnings are what they are.
But you think margins and earnings are just too high. I mean, and will mean revert downward.
I think they'll mean revert.
I'm not sure. I'm agnostic on that.
But why don't we continue this in the free-for-all at the end?
Elroy Dimson is going to join us now. Thank you very much, and thank you for inviting me. It's a long, long journey. Just upstairs in my house to the computer here. I'm enjoying interacting with you, and I'm enjoying being sandwiched between Roger offering comments and Roger's presentation, which comes next, because as you'll see, Roger had quite an influence on what I and my co-authors did. So what I'm going to do is share my screen with you. Okay. Well, thank you for passing the opportunity to me to share some of my thoughts. A lot of this goes back to work which was inspired by several of the people that Ed introduced, and in particular, as I said, to Roger Ibbetson's initial research. Together with my two colleagues, the three of us spent a career at London Business School. Now, the two colleagues were Paul Marsh and Mike Staunton. But we produced a number of pieces of work which culminated in, 23 years ago, a book which we called Triumph of the Optimists. And this, I think, is a good starting point for us, because the optimists for us were the people who invested in risky assets, in stocks and shares, not the cautious individuals that bought government securities like government bonds and treasury bills. And the 20th century, which is what we focused on, was the one in which the optimists won. And even when we wrote this book, we warned about the fact that outside of that period, it was our guess that investors in the stock market may not have done quite so well. It turned out they didn't do so well in the 21st century so far. And we owe a huge debt to Ed to encouraging us to pursue ideas which Jeremy Siegel had started with, but looking back to see whether the excellent performance during the 20th century actually was typical of the stock market as a whole. So we thought we were writing a book which would focus on the equity risk premium, but we discovered there were lots of other questions that one could put to the data. And we ended up each year producing an update. This is the current update. We called it the Global Investment Returns Yearbook. And we look at both updates to our long-term data and persuading the data to give us answers to other contemporary issues. So different essays in each year. I'd like to go back to the charts that we were looking at earlier. Here's the US chart starting in 1900. Equities doing incredibly well. Government bonds doing much better than treasury bills, but way behind equities. And you can see also the impact of the exchange rate against the US dollar, which on this chart is just a flat line. We had already done some work on the UK, and the UK is remarkably similar. Equities doing incredibly well, government bonds doing nowhere near as well, although in the end beating treasury bills, and the exchange rate against the dollar revealing that the pound lost a little bit of value in real terms compared to US currency. But the natural question was whether the pattern was universal, and the work that we did took us into drawing on series that had been compiled by people who were inspired by Ibbetson and Sinquefield for their own country. We were one of them. But it turned out lots of other people were doing the same thing. This was the days of communicating by sending documents over the internet, but not the days of putting together large-scale data sets embracing different countries. And that's what we took on for ourselves. So you'll see here that equities beat bonds, beat bills, in two countries. What about other countries? Well, we collected together initially in the year 2000, we ended up with 10 countries, but that has grown over time. And today it stands at 23 countries for which we have data beginning in 1900 and going through to 2023. And for all but two of them, it's an unbroken history. There is a gap in the middle for Russia and China, where we can't link those two together. So we've got data which is fairly self-explanatory, except a few abbreviations which are worth explaining to those viewers who are unfamiliar with the ISO abbreviation. So at the left, we have AUT, which is Austria, and towards the right, we have AUS, which is Australia, right beside the United States. And what I want to show you, first of all, is what the total returns were on equities. So we look at complete returns, capital appreciation, plus the thrown-off income. And you can see here what the annualized geometric mean returns were for each country. Going across the bottom, it's Austria, Italy, Belgium, Germany, France, Spain. And then we've got one or two abbreviations in there. The first one is EMG, which is emerging. And we've got a number of others that I'll come to at other points. So everywhere, equities beat inflation. We also looked at government bonds. Government bonds generally beat inflation. Those grey bars are above the zero line, but in some cases they got left behind. For all of these countries, our data covers 124 years from 1900 to 2023, including Austria on the extreme left, where there was an impact of a terrible hyperinflation. But we do leave out 2 years for Germany. Germany, which is the fourth one along, which there is a year in which there was a complete 100% write-off, and we can't fit that on the charts. So all other countries, we have a record which is spanning the full 124-year period. And then we collected treasury bills, or in earlier years, the nearest equivalent to treasury bills. And you can see on the extreme left the adverse impact of inflation on Austria. But you can see treasury bills sometimes were on the right side of zero, sometimes on the wrong side of zero. So they gave a real return, which was just positive, but not very exciting. It's worth looking at particular countries. The United States did very well. It gave you from equity 6.5% annualized real return, fully adjusting for inflation. There's my country. I showed you the previous chart, Great Britain. The United Kingdom gave you a return of 5.4%. If we looked at the world excluding the United States, WXU, the return was considerably lower than the world than the United States was. So there's a big gap between the two. And if we look at the world, this is a market cap weighted index in common currency for the world. The difference between the first charts that I showed you previously, the line plots, and this one, is the line plots were in local currency adjusted for local inflation. But on this chart, we've moved into the US dollar because for these groupings, like the world excluding the USA, or the world, or indeed emerging markets, we need common currency. And so all of these countries are also shown in dollar terms. Because over the long term, currencies and relative inflation move hand in hand, this chart would look very similar if it were done in terms of local currency. So what does the risk premium look like? For the world portfolio, you would have got a 5.1% a year compound return from equities, well above that you would have got on government bonds. And so the risk premium was 3.3%. And if we look at the risk premium the way that professors of finance prefer it, that is, look at the risk premium compared to treasury bills rather than compared to the return on government bonds, the risk premium was 4.6%. So the risk premium is an important number, and that's what we'll dig into a little bit more. But the US performance was exceptional. And so there are two ways of addressing the fact that the US was exceptional. One is to look at longer periods of time, and that's what Ed has pioneered, and we'll look a little bit at that as well. And the other alternative is to look at different countries. it's difficult to get a wide range of countries with good quality indices going back very much before 1900. Let me show you just a little. If we look at US equities and government bonds, we can look at comparison between the two. The two sources that I highlight there are global financial data and the Dimson, Marsh, Thornton series that I described. And the shaded area is the equity premium relative to bonds. If we add in the extra data, which we've got from Ed McQuarrie's work, the equity premium shrinks to being small, we reckon mildly negative. And so in a review paper, which I'll be preparing with David Chambers, Antti Ullman, and Paul Rintamaki, our estimate is that the equity premium looking back is of the order of about 2.5% over 223 years. And that's the additional data beyond looking at particular countries, but also looking at the longer period. I'll pause there.
Just a quick observation. When Peter Bernstein and I did the paper in 2002 on the risk premium, we came to the conclusion that, well, the excess return over the Ibbotson span through that date was about 5%, that a lot of that was revaluation alpha, as we've discussed earlier. And we came to about a 2.5% reasonable expectational risk premium as the norm over that same span, which would be roughly the same as the observed after you take away revaluation alpha. So Elroy, I find it wonderfully reassuring that you're finding over two centuries is that the norm is about 2.5%. It doesn't solve the risk premium puzzle. The risk premium itself, fear premium, should be smaller than that if it's a risk premium. If it's a fear premium, maybe it explains it better.
Well, thank you. I'd say one comment here. When we started doing this work, the textbooks, including those by my colleague Dick Greeley, were talking about risk premiums as something of the order of about 8%. And by the time we had done a bit more work, we've roughly halved that. We were down sort of 4% or so. And now we've done a bit more work, and we're at 2%. It's the most important number in finance. But really, I don't know what it is.
I remember that the equity risk premiums used in many of the formulas is the arithmetic equity risk premium, which is substantially higher than the geometric that you and I have produced in our
Excellent
graph.
Point.
By several percentage points. I would also like to mention that again, extending it back to Ed's bonds of the earlier period, are we getting the risk-free rate, which is what we economists want to compare it to? Now, you could argue there really weren't any risk-free bonds, but as I mentioned, and I think Ez mentions that those bonds were extremely riskier with a lot of equity-like qualities. So naturally, you would find a lower equity risk premium using those bonds as you would, let's say, today's government bonds or looking forward.
I have to respond to that because we've now taken the UK data also back to 1800, and I can show that to you later on, depending on how the discussion goes.
Okay.
A question that I'd like to raise either now, although we're running out of time on this segment, or later, is how risky were those early bonds and where did the risk come from? Was it sovereign risk? I mean, I know the U.S. government was not particularly powerful or solvent in the late 1700s and early 1800s. Or are we picking up some corporate risk? I just don't know that much about the bonds that were used.
I would interject the observation that survivorship bias also may be to some extent missing from that earlier data, whether it's bonds that default or stocks that go bust. There'll be a propensity or a tendency to include stocks that were survivors and bonds that were survivors, with some obvious major exceptions.
I think when you're actually taking if the bonds come from indices, and they are the yield of these indices, there can be really a potential distortion because if they don't pick up the individual bond changes. Usually, if there's like a double A index and something becomes from a double A to a single A and drops out of that index that doesn't show not only the defaults, but doesn't show the change in quality that takes place. So I'm pretty sure that the bond returns have a stronger survival bias than the equity returns, actually. I would imagine that certainly in the later periods they do. If you're taking corporate bond returns and any measures of it. Nowadays we can measure them both correctly because we measure them by the individual bonds. But when you basically create bond indices and creating returns from bond indices, there can be big distortions on corporate bonds that could default. And that's why it's so important to actually try to get the default-free bonds in here. And of course, that's what we're also really interested in when we talk about the equity risk premium. There's some, as the equities compared to a default-free bond.
I think Roger is right, but Ed, you should take the podium here.
Okay. Roger's completely correct in what he just said. In fact, it's in a footnote in his 1976 paper. And I can verify that his corporate bond measure in the SBBI suffers exactly from that problem. In a separate piece.
I admit that.
Yeah, it was
pretty well known.
You admitted that in 1976, for heaven's sakes. When I went back and collected actual corporate bond prices, 1929 to 1938, with not taking them out until after they got defaulted and downgraded, it did lower the returns relative to Rogers Index. But keep in mind, in my older data, there really aren't much in the way of corporate bonds until 1857. And the chart in the paper is an aggregate of federal, municipal, and corporate. It's only 1897 to 1925 where I have a pure corporate bond index, and were, again, observed on prices with defaults included, et cetera. Larry?
Could I just interject for a second? I mean, Ed, why you said, why do you have a 90 or 85 to 90% correlation between stocks and bonds in that very early period? I mean, that doesn't sound like a risk-free type of instrument that we deal with today.
Unless, but most definitely not least, is Roger Ibbotson.
All right, so this is, I guess this is, we've been calling things iconic, but from my perspective, I guess this is my iconic chart. It actually was first developed back in the early 1970s when we were putting this data together. I actually was working I was a PhD student at the University of Chicago, and I was working in the investment office managing the bond portfolios actually at the university. And Fisher and Laurie had put together the stock returns with the Center for Research and Security Prices and this would be early 70s, but Fisher and Laurie had only updated their data till 1968. So people are always asking me, when are you going to get the updates? And they never really came at a regularity at that time. Later, I became executive director of this, but speeding it up. But ultimately, what we did is St. Phil and I produced our own data sets now, and the whole purpose was to measure the stock market, but also there was so much discussion about risk premiums, the equity risk premium, because the capital asset pricing model had come out in the around 1965, and so it talked about an equity risk premium. Well, we didn't have a measure. At the same time, we didn't really have measures of the horizon premium on bonds, and we put in corporate bonds. Not as good of a measure, I might say, but we put in corporate bonds to try to pick up a default risk premium. So we wanted to pick up all these different risk premiums because people were talking about all the time that there was not a measure of what these premiums were. So this was our first attempt, and of course we've continued on And then even at that time, we basically projected, extrapolated on and make a forecast for the stock market to what would happen in 2000. Specifically with the Dow, we were pretty correct on that one. But anyway, you can see now that this is the chart with the dollar. In the stock market, it rose to over $14,000, of that 10.3% compounded rate. So far, most of us have been talking about this in real terms. You could convert all these things into real terms by that inflation number went up 17 times. If you divide every one of these numbers by 17, you would get the compound valuation at the end of the period in real terms. Then you could take the 98th root of that. Obviously, we can't do that. I can't do that live for you, but we could easily convert all these things to real terms, but they're not presented that way. So I will say, though, if you want to get a rough cut of real terms, just take this inflation, which is compound annual returns here, take these inflation numbers, 2.9, and subtract it from these other numbers, and you'll get the return in real terms of these things. This is compound, this is geometric math, so it's not exactly, you can't exactly subtract. Well, it's pretty close. Anyway, the equity risk premium you can see is converted treasury bills. It's more like 7% over this long period there. So it's a number that's quite a bit larger than we've been talking about today. It's certainly, Elroy has pointed out that there's a lot of survivorship there. And the fact that the U.S. has been one of the best performing economies and one of the best performing stock markets, and the century, the 20th century, and since the beginning of the 20th century has been much better than the 19th century, I guess. So not necessarily using these as projections going forward, but I will note here that these equity risk premiums over this period have been quite high. So when you get an idea of, by the way, and there are two ways we talk about the equity risk premium. We talk about the realized equity risk premium and the expected equity risk premium. If we're using the term equity risk premium, we sort of use them interchangeably, but of course, realized and expected are different. But you know, the only way, one of the ways we get an idea of an expectation is to look at the past. That's why we're so interested in the past, because it tells us something about the future. This next chart just basically shows you the volatility of stocks, large cap stocks versus long-term covered bonds. They're on the same scale here, so it's pretty clear that stocks are riskier than bonds. Although what's happened actually is that really up until about the middle of World War II, stocks were really risky. They were very risky during the Depression. They were very risky during the war, and we didn't know what was going to happen. And then the risk settled down. Meanwhile, the bond market risk is much riskier today than it was in the earlier periods. So if you're just going to talk about risk as the cause of everything, you might think that the equity risk premium perhaps should be lower compared to bonds anyway than it was historically. These are default-free, but I'm not saying you should compare it to a long-term bond. In fact, when you do look at the long-term bond, which I'm going to show you here, and this has been part of the discussion, this is the summary of yields from U.S. government bonds from 1926 to 2023, the last 98 years. Well, the yields actually follow a not quite random process here, I guess. They peaked out in 1981 at over 13%. And then they bounced after that. And so I've got them in two different colors. As the post-1981 is a dramatic period of falling bond yields until very recently. We've had the last couple of years, we had a sharp rise in yields, but they tried to combat inflation with the Fed's aggressive moves and so forth. But these two periods are very different from each other, and they they give us some idea of how we should look at the equity risk premium. So here I'll give you the actual numbers of the two different periods. The first column is the whole period, the whole 98-year period, and we got the dividends and capital gains as well as the yields and capital gains on the bonds. I'll focus on the first two, just the long-term share. But if you look at the long-term, both of the earlier period, 1926 and 1981, you can see the total return of stocks was 9.14. Compared that with 1181 in the later period. So stocks actually had higher returns in the later period than the earlier period. But if we compare them to the total return of bonds, well, bonds had a 298 versus an 805, so that in the last period, if you compare, you want to say, well, this is the equity, the realized premium over bonds. It was quite small because it was only 376 basis points in the last period, where it was taking 914 minus 298. It's 616. So it has been argued. In fact, by Ed McQuarrie in particular, been arguing that that premium was so high in the 26 to 81 period, and then was so low after that. Well, that's true, but you shouldn't be looking at the realized total returns on bonds, especially because you want to go back to which is the expectation. In bonds, you actually have an expectation. The yield of a bond, especially if it's default free, with the yield over the horizon is the expectation of the bond return over the horizon. And so what's different about the two periods, of course, is during the 26 to 81 period, you had a capital loss. At the 82 to 23 period, you had a capital gain. So if you compare now just the difference between the total return and the bond yield for the earlier period, 914 versus 450, well, that difference is 464. And compared to the yield in the latter period, 1181 minus 568, well, that's over 6%. It's 13. So it's, if anything, the last period has been a better period for an equity risk premium measure. It's not lower; it's actually higher over the latter period. So this is one of the big charts that have been shown repeatedly about how different those two periods are. But what's so different really is the behavior of the bond market, not the behavior of the stock market. The stock market's basically equity risk premium has held up. So I guess to summarize this whole thing, certainly in the U.S. market, the equity risk premium has been broadly positive over the 98 years. Of course, it's not positive every year. That's what risk is all about. And there are certain periods and even extended periods when you can do worse in the stock market. But essentially, since 1926, you certainly have done better in the U.S. market in stocks versus bonds. And it's been even more true, I would say, in more recent periods. Yes, you've done very well in the bond market if you could have bought those high yields and picked up the decline in yields and the capital appreciation that went with it. But that's not really a forward equity risk premium, which Rob said we should be interested in. So I'll agree with Rob on that. I don't agree with Rob often, I guess, on a lot of points. But I certainly agree with Rob on that point that we're interested in forward equity risk premium, and this is the way you should really approach measuring that.
If I could interject a couple of quick comments, Roger. One is the capital gain portion of this exhibit, I think should correctly be disaggregated into capital gain from underlying structural growth and capital gain from revaluation. And if you do that, you get a richer understanding of the sources of the total returns. And the gains that are structural, it's okay to extrapolate those. The gains that are revaluation, it's a little more dangerous to do that. The other observation I'd make is that you say that bond returns can be forecast because the yield is the return.
It's the expected return.
Yes. The expected return on stocks can also be estimated. In the case of bonds, you can estimate the nominal return with precision. In the case of stocks, you can estimate the real return with some precision. The real return, it would be the current yield plus an extrapolation of long-term historical growth rates, and plus or minus any mean reversion in valuations. And I'm perfectly okay saying mean reversion is historically reliable, but I'm perfectly content to toss it out and say yield plus historical long-term growth is a reasonable real return expectation. So the big unknown is the inflation component. So for bonds, easy to forecast long-term nominal returns. That's your expected return. And for stocks, easy to forecast long-term real returns. So
I don't think it's actually easy to forecast long-term real returns in the stock market. There have been a lot of structural changes we've been talking about. For example, one of the structural changes you mentioned is that the expansion of the price earnings ratio, so price, whatever ratio I talk about in the stock market, that's been expansion. And of course, I've written on that and several articles on that topic. And certainly I admit that there has been expansion in the ratios in the stock market. But part of the reason of that about dividends anyway, is as we've discussed before, that buybacks have replaced dividends for the most part. They're really a much more flexible way of paying on your money because you can pay it out when you want. You don't have to worry about the strong signal so much. In terms of you cut your dividends like a disaster, whereas you can you can pay out your buy your buybacks when it's convenient for you and whatever except you want to. Like historically, it's had a lot better tax aspects. U.S. too, and so forth. So buybacks, I think, are a natural replacement to dividends. And yes, I'm splitting it up here in terms of dividends and capital gains, but the dividends are totally different today. They're much lower today. And in the 19th century, of course, the dividends were really high. Basically, most of the securities were issued at par, at 100. Equities I'm talking about.
Yep.
And so they looked like bonds. I remember when we were collecting the data when Will Getzman and Ling Peng and I put together our 19th century, we had it together. We were puzzled at first because we couldn't tell an equity from a bond because everything was being priced around 100. But when you price something at 100 and we keep it, if it stays near 100, the only way that happens is pay out almost all of the return as a dividend. And that keeps up the price closer to 100. Well, that general shift has been going on. So, we pay out almost everything to now we're paying out almost nothing in dividends. Mm-hmm. And good shift was going on throughout this. But through all these shifts, there has been an equity risk premium, basically. And I guess it's just...
I don't disagree with that.
It's just a matter of how big it is. I guess it's the question. And of course, we have different interpretations of how big it is or how we might measure it.
Say, Roger, could you stop sharing? I want to share one screen to come back to your point that real returns for stocks are hard. So you mentioned hard to forecast equity returns. And on a short-term basis, that's very true. The CAPE ratio is a weak predictor of one-year returns, as everyone knows. It's a mediocre predictor of 5-year returns. It's a damn good predictor of 10 years returns, and it's a remarkable predictor of 20-year returns. So I think you can forecast long-term returns with some accuracy from current valuation levels. we should reasonably expect significantly lower long-term future returns. I would also draw attention to the fact that we have had outsized growth in earnings in the last quarter century, the period of time that Jeremy notes that we've been debating these topics. I don't disagree that buybacks are a big part of the return. I view it as something, you can see that in the different slopes for the bonds, for the earnings and the dividends. The dividend slope and the earnings slope from the beginning of the Shiller data is near identical. Just a tiny bit slower on the bonds, on the dividend side. Subsequent to that, the slopes have diverged. And a big chunk of that is buybacks. Buybacks are overstated as a source of return because buybacks are often announced and then don't happen. So one of the things we like to look at is buybacks defined as net reduction in outstanding stock float over a rolling 5-year span. And if you do that, you find that buybacks are a very real phenomenon, but they're smaller than what most people think. I don't think it makes sense to expect earnings growth to remain abnormally large, because what has happened here is that earnings have gone to a unprecedented historic peak relative to the 10-year average. So the CAPE earnings are far behind current earnings, and that is historically strongly predictive of mean reversion in earnings. So I do think that there are interesting reasons to believe that the natural relationship between dividends and buybacks has indeed fundamentally changed.
Yeah, I would like to say I would not use just the reduction in shares, because normally growing firms will issue more equity over time, so that basically, you could have buybacks that actually keep the equity constant, and that is a buyback, because firms can, if a growing firm can increase its debt and its equity by floating secondary offers, and I guess they now call it follow-on offerings. So I think I'm a little bit wary, Rob, of your definition of reduction in shares, because there normally is an upward trend of shares itself.
Yeah, that's the natural dilution of a growing economy, and that's the reason that earnings per share cannot, on a long-term basis, keep pace with real GDP growth. The possible exception to that is if buybacks become so pervasive that they entirely offset new share issuance and IPOs.
Let me just say for clarification, we've never advocated should match real GDP growth. It's always been per capita. And I've written up a topic many times that we're talking about. Per capita.
A lot of people in academia think that earnings and dividends should grow with GDP. I was not referring to you. I was referring to others who've made that case. Per share earnings and dividends generally won't keep pace with GDP growth.
Let me say also, though, on this whole thing, I want to say something about, I think it's unfortunate that people have talked about the economy so much in terms of real GDP growth, and they ignore population growth. It sort of distorted our whole view of which countries are growing and which countries aren't.
No.
They may be growing in population, but they're not growing in income and so forth.
You got countries with 3% population growth per annum, and if their GDP is growing 3%, the average person there is stuck in squalor unchanged.
But this is typically, even in the newspapers today, the way everything is talked about, and the newscasters and everybody else. They talk about growth. Because they're adjusted for inflation.
I want to go back to the fact, Rob, that I do think we've had some net reduction in. I mean, buybacks have been so strong that over most of the past, or many of the past 20 years, we've had reduction in share count. So
Right.
it has been strong. I mean, I go back to a simple example: a firm earning 10% on its earnings, pay all out of dividends, earnings per share will be totally flat. A non-growing company, same non-growing company, just buys back its share. Its earnings per share growth is 10% per year.
Mhm.
You know, I don't know. You can't get around that math, in my opinion.
Larry?
Yeah. Go
Yeah.
ahead.
If I may, I'd like to take us back to the history. All right. So the point of this chart, and by the way, if we took it out through 2022, the correlation would already be back up to minus 0.17.
Right, as I
the
showed
point-
in mine.
Yeah. The point of this chart, and of several companion charts in the paper, is to get across the notion of non-stationarity, that everything changes, nothing stands still. Through the first, through about 1871, these are treasury bonds, these are state government bonds, and the correlation is very, very high. Now, if you want to say that, yeah, I know these U.S. bonds were called treasuries, but they really weren't, then, Elroy may have some data for the 200-year series that he is preparing. I don't think you can call the British consols from 1800 to the present anything other than the criterion risk-free long-duration instrument. So if the correlation with consols in the 1800s looks like the 20th century U.S. ones, your point holds. If the consoles to correlation to UK equities in the 1800s looks like my chart, then I'm going to suggest that my interpretation holds, and my interpretation is it's not stationary. The correlations are not stationary. The standard deviations are not stationary. The equity premium is not stationary. The equity premium comes and goes. And one more thing, Larry, I don't know if we really can do this in the time remaining. The viewers may know that we're missing Hank Bessenbinder, who was injured and could not attend today, may be able to get his stuff into the print version. I had a useful reply to it, and if you'll give me the microphone for 3.5 minutes, I think I can get it across.
Please.
Before you do that, it show, even with the hookup that we have in the last 2 or 3 years, it's a downward movement, which of course implies a lower return because it's a better hedge in any equilibrium pricing model that you have, and it becomes more like what you would expect from the risk-free rate, and therefore you would expect under those circumstances a bigger equity risk premium in the later years than you would in the earlier years.
Or it fluctuates.
It fluctuates, I know, but the trend is definitely down, even with the hookup recently.
Larry, I do think we should also spend some time in the remaining minutes talking about the predictability of stocks, because I think what Rob has shared is wrong. And if it's wrong, viewers should hear an alternative interpretation.
I'll stop sharing.
Well, we have a lot of stuff on the table here, and I think that rather than trying to summarize Hank Bessenbinder's work in his absence, I think, Elroy, you have a very a good point, and why don't you do this?
So the dilemma is this, that if we draw a line from a starting point to an ending value, and we then look at how a portfolio is doing or an index is doing, it's above or beneath it, it looks as though it reverts to the mean. But we don't know what that mean is going to be beforehand. So what Rob is talking about is knowing something about earnings, and CAPE is then a clue as to what you can expect to happen. That's very difficult to operationalize. we've tried doing this for all the countries that we have data for. There are no decent earnings figures for any countries apart from the United States if you are a long-term historian. So we've looked at the cyclically adjusted price dividend, not the cyclically adjusted price earnings ratio. And if you update that as you go through time and you don't know what the performance that you're going to see as a long-term record will look like, then CAPD, which is very similar to CAPE, doesn't help you. It doesn't enable you to predict what's going to happen to stock prices. There's only one exception, I think, where it looks as though there may have been some predictability, and that is quite anomalous. It's Britain in 1974-5, where stock prices halved and then recovered and then doubled, all in a very short period. But that aside, there does appear to be the kind of predictability that Rob is now nodding his head, I think in agreement with me, that he was putting forward earlier.
I'm nodding my head because price to dividends is CAPD is empirically a little less powerful than CAPE, perhaps because of shifts in different dividend payout preferences. Payouts versus buybacks, payouts versus retain and reinvest. But I'm also nodding my head because that U.S. history that I used is a remarkably benign history. We've had, apart from attacks on the World Trade Center and Pearl Harbor, we've had a century and a half with no wars on our own soil. And that's a remarkable history, almost unmatched in the world. And that makes a huge difference.
By the way, 5 minutes more group discussion, and we're going to wrap this up.
Quick question for Elroy.
Yeah.
Elroy, I believe you have a slide. You showed that you finished with the slide of 200 years of U.S. history that you're putting together. I think you have a slide of 200 years of UK history split by century?
So nobody would ever ask. I have to lower my electronic hands. I will have to share my screen if I'm able to. This is the same study in which we have the 20th and a bit of 21st century, and on the top row, the 19th century. Here, this is the same study coming up to the UK. Here's the 100 years and a little bit we've had of this century. And here's what we can do if we bring in the earlier periods. And in this particular case, the Dimson, Marsh, Staunton and the Global Financial Data series end up being remarkably similar. And so this is making a comparison of equity returns with government bond returns where they are genuinely default-free. The survivor bias that we have here is a different sort of survivor bias. This is the survivor bias of a country which didn't have any of the excitement of almost all the countries around the world, not even the excitement of 19th century United States. So you see there that 2.5% or so as the equity premium based on good quality data for the United Kingdom looks very similar.
So, Elroy, are these the longer-term bonds? Are these the old bond market? What kind of bonds are we talking about?
These are UK government bonds, which for quite a long part of this additional first row, 1800 to 1899, were perpetuals.
So they're probably, I'm just suggesting that maybe part of the, maybe it might be underestimated because of the big horizon premium, I guess, part of it. A bond yield flips upward, and so these generally the bond returns for longer bonds have higher returns than shorter term bonds.
Well, who knows how we should think about the maturity or horizon premium when the horizon is infinity? But yes.
Well,
I heard
the reason I asked Elroy to put this slide back up was it nicely encapsulates, independent of any data that I collected, how non-stationary the equity premium is, even over century-long periods. 100 basis points in change in one century, 500 basis points in the other. I think it's time to stop giving point estimates of the equity premium. I think we do the investor community a disservice on that end. I think it's time to start, emphasizing how much it fluctuates. Larry?
Well, I think that comment summarizes very nicely your own work and the tone of the conversation, which has been remarkably civilized. I want to thank everyone for behaving. And I believe that unless we have a brief comment from someone at this time, we should close.
I just want to thank you, Larry, for including me with this august company, and want to thank everybody for a very fun conversation and exchange of ideas.
And I would apologize to you, Larry. You were hoping we would really beat each other up. And you will be very disappointed that we have expressed appreciation for what our colleagues have done.
Yeah, it was.
I think most of us appreciate that there's a lot of uncertainty in pretty much all of the assertions we might choose to make, and none of us has a crystal ball that can tell us unequivocally the future.
Well,
It's
that's
been great
right.
fun being on this panel, so thank you too. Thank you all.
Thanks, everybody. A good time was had by all.